Welcome to the deep dive. Today, we're not just looking at pages, we're aiming to crack the code of business finance.
That's right.
We've got excerpts here from Intermediate Accounting 1, part of the QuickStudy business series. Think of it as our guide.
A roadmap, maybe.
Yeah, exactly. And our mission is to really dig into the core ideas of financial accounting, those essential financial statements, and the concepts that make it all work.
We want to give you those key insights, the ones that, usually take a lot longer to really grasp in a formal setting.
Forget the dry textbook stuff. This is about understanding the financial pulse of a company.
Exactly. We'll look at why financial accounting even exists, walk through the big statements, income statement, balance sheet, statement of changes in equity, cash
And the
flows.
rules behind them, right? Like what makes the information reliable and the auditors, the financial detectives.
Yep, cover all that ground.
Okay, so let's jump right in. Why should you, listening right now, care about this? Well, ever wonder if a company's actually doing well or just, getting by?
Or maybe heading for trouble.
Exactly. Whether you're thinking about investing or trying to see if a business is a solid partner,
Or even just wanting to understand the business world a bit better.
this knowledge is, frankly, power. So we're diving into the foundations.
Okay, so foundation one, financial accounting. What's its main goal? Really, it's about getting useful financial info to people outside the company,
Why to?
primarily creditors, people who lend money, and investors. They need good information to make smart decisions about, well, where to put their money,
Decisions based on what, though?
mostly about assessing a company's future cash flows. How much cash is it likely to bring in, and when? That's the key question they're trying to answer.
And how do companies actually share this information?
Mostly through the financial statements. These are the official reports. They communicate how the company performed, its financial position, how cash moved around.
Kind of like its report card and bank statement combined.
That's a good way to put it, yeah.
But there have to be rules, surely. Companies can't just report whatever they want, however they want.
Oh, absolutely not. That's where GAAP comes in. Generally accepted accounting principles.
GAAP. Okay.
Think of GAAP as the shared rule book, the common language for business accounting in the U.S. It's a whole collection of standards and practices developed over time.
To make things consistent and comparable.
Exactly. Consistent, comparable, understandable. Companies use GAAP to organize their data, put it into these statements, and add important details disclosure so users can make sense of it all.
Okay, GAAP is the rule book,
Yep.
but what are the big picture goals? What are these financial reports trying to achieve?
Well, there are a few main objectives. First, give investors and creditors what they need to decide about providing capital. Is it a good bet? What's the risk?
Makes sense.
Second, help them get a handle on the company's cash flow prospects. How much cash might it generate?
Right, back to cash flow.
And third, just provide a clear picture of the company's resources, what it owns, its obligations, what it owes, and how those things have changed. It's really about transparency.
Okay, transparency. Now, when we look at these reports, are there some basic assumptions baked in, like ground rules for how the numbers are put together?
Yes, definitely.
Yeah.
There are some fundamental assumptions. First, the economic entity assumption. This means the business is treated as totally separate from its owners.
So my personal grocery bill doesn't show up on my company's books?
Precisely. Then there's the going concern assumption. We assume the business will keep operating indefinitely unless there's clear evidence it won't.
And that affects how you value things.
It does. Like, you wouldn't value assets at liquidation prices if you assume it's staying open.
Right.
Then the monetary unit assumption, we report everything in a stable currency like US dollars and generally ignore inflation in the basic statements. And finally, periodicity. Even though a business runs continuously, we need to chop its life into time periods like quarters or years to report performance regularly. You'll see statements say, for the year ended December 31st, for instance.
Got it. Assumptions. Now, what about the principles? The actual rules for recording things?
Right, the practical rules. Revenue recognition is a big one. The basic idea. You recognize revenue when you've essentially done your job, delivered the goods or services, and you reasonably expect to get paid.
So it's not just when the cash comes in.
Not necessarily. It's when it's earned and realizable. Two key tests.
Okay. Earned and realizable, and the costs associated with earning that revenue.
That's expense recognition. The core idea here is the matching principle, where cause and effect match the expenses to the revenues they help generate.
Like the cost of flour for the bread you sold this month?
Exactly. But sometimes you can't directly match. So for assets that benefit many periods, like a machine, we use systematic and rational allocation, that's depreciation.
Spreading the cost out.
Right. And for other costs that are hard to link directly, we often use immediate expense recognition. Just
Mhm.
expense it right away. Things like, say, the CEO's salary.
And the dollar amount you record, is it today's value or what you paid?
That's the historical cost principle. Generally, you record transactions at their original cost when they happen. It's seen as the most objective number at the time.
Even if the value changes later.
Even then, the initial recording is at historical cost. And lastly, super important, is the full disclosure principle.
Meaning, tell everything.
Everything that could reasonably influence a user's decision. Not just the numbers on the face of the statements, but explanations in the footnotes, extra schedules, that kind of thing.
Okay, principles covered. So we have all this information prepared according to GAAP. What actually makes it useful?
The qualitative characteristics.
Yeah.
These are the ingredients that make the information valuable. The main ones are relevance and faithful representation.
Relevance meaning?
Meaning it makes a difference in a decision. It might have predictive value, helps forecast the future, confirmatory value, confirms or changes past expectations, or it relates to materiality.
Materiality, is that like size matters?
Pretty much. An error or omission is material if it's big enough or important enough to influence a user's judgment. A $1,000 error might not matter to IBM, but it definitely matters to a small local shop.
Right. And faithful representation.
That means the numbers and descriptions actually match what really happened or existed. It needs to be complete, nothing important left out, neutral, unbiased, and free from material error. It's about telling the truth, the whole truth.
And nothing but the truth, basically.
Essentially, yes. A reliable picture.
Are there other qualities that help?
Yes, the enhancing qualities. These make the information even better. Comparability lets you compare a company over time or against other companies. Consistency in methods helps here.
So you can spot trends.
Exactly. Verifiability means different knowledgeable people could look at the same info and reach similar conclusions. Timeliness, getting the info out before it's stale and useless. And understandability.
Meaning it's clear.
Clear and concise, so someone with reasonable business knowledge can make sense of it. It shouldn't be deliberately obscure.
Okay, great foundation. Now let's get into the statements themselves. Where do we usually start?
Often with the income statement. Its job is simple. Show profitability over a period of time.
Like a quarter or a whole year?
Right. Our source mentions examples like 3 months ended December 31, or fiscal year ended June 30. It's like a video of performance over that time.
What are the key pieces on there?
You've got revenues, earnings from primary activities, and expenses costs incurred to get those revenues. Also, any gains or losses from side activities.
And the bottom line?
Is net income or net loss? Profit or loss for the period. A really important line often highlighted is income from continuing operations.
Why is that one so important?
Because it strips out any unusual or discontinued parts of the business. It gives you the best sense of the core ongoing profitability, which helps predict the future.
Can you give some typical examples? Revenues and expenses.
Sure. Revenues, sales, services, interest earned, rent received, expenses, cost of goods sold, salaries, rent paid, depreciation, interest paid, taxes, the usual costs of doing business.
And gains or losses.
Those are usually from peripheral things, like selling an old delivery truck for more than its recorded value. That's a gain. Selling it for less is a loss.
Now, I saw something called comprehensive income mentioned. How's that different from net income?
Good question. Comprehensive income is broader. It starts with net income, but then adds in other changes in equity that didn't come from owners investing or taking dividends out.
Other changes, like what?
These are called other comprehensive income, or OCI. Think of things like unrealized gains or losses on certain types of investments, or adjustments related to foreign currency translations if the company has overseas operations.
So net income plus OCI, comprehensive income.
Exactly. It's meant to be a more, well, comprehensive measure of the overall change in the company's net assets from non-owner sources.
Okay. Income statement covers performance over time. What about a snapshot? Where do we see what the company owns and owes right now?
That's the balance sheet, also called the statement of financial position. It shows assets, liabilities, and equity on a specific date, like December 31st. It's a photograph, not a video.
And it also has to balance.
For always.
Well,
The fundamental equation is assets, liabilities, plus equity. What you own equals what you owe to creditors, plus what you owe to owners.
let's break that down. Assets are
Probable future economic benefits. Things the company owns or controls that will help it generate cash later, usually split into current assets.
like cash, receivables, inventory, things used within a year.
Exactly. And long-term assets, which last longer than a year. buildings, equipment, that sort of thing.
Okay. Liabilities.
Probable future sacrifices.
Yeah.
Obligations to pay cash or provide services later. Again, split into current liabilities due within a year, like accounts payable to suppliers, short-term loans,
And long-term liabilities.
due further out, like bonds payable, long-term bank debt.
Which leaves equity.
Equity is the residual interest, what's left for the owners after you subtract liabilities from assets. For corporations, it's stockholders' equity. Key parts are paid-in capital money owners, invested and retained earnings.
Retained earnings. That's the accumulated profit kept in the business.
Precisely. Profits earned over time that haven't been paid out as dividends.
Okay, balance sheet gives the snapshot. What about the statement of changes in equity?
That one bridges the gap between balance sheets. The statement of changes in equity shows exactly how each equity account changed during the period.
Like retained earnings, common stock.
Yeah. For each one, it shows the beginning balance, what increased it, what decreased it,
Yeah.
and the ending balance. It reconciles the equity section.
The source specifically mentions a statement of retained earnings. Is that part of it?
Often, yes. Or sometimes it's shown separately. The statement of retained earnings just focuses on that one piece of equity. Starts with beginning retained earnings, adds net income, or subtracts net loss.
Subtracts dividends paid out.
Right. And adjusts for any prior period adjustments. Then you get ending retained earnings.
Prior period adjustments, what are those? Sounds like fixing mistakes.
That's exactly what they are. Correcting significant errors found from a previous year's financial statements. You don't run them through this year's income statement because they relate to the past.
So you adjust retained earnings directly.
Yes, the beginning balance,
Yeah.
it ensures the past is corrected and this year's income only reflects this year's activity.
Makes sense. Last main statement, statement of cash flows. Why is this one so important if we already have the income statement?
Because income isn't always cash. The statement of cash flows tracks the actual movement of cash inflows and outflows. It's vital for understanding a company's liquidity.
And it's broken down into sections.
3 main activities. Operating activities cash flow from the main day-to-day business, related to net income. Investing activities cash used to buy or received from selling long-term assets, like equipment or investments. And financing activities.
Which is about debt and equity.
Right. Cash from borrowing or issuing stock, and cash paid out for dividends or repaying debt.
What about important things that happen without cash changing hands, like buying a building by issuing stock?
Good point. Significant non-cash investing and financing activities like that are usually disclosed separately, either at the bottom of the statement or in the notes, so you still see the full picture.
The source also mentions cash equivalents and restricted cash. Quick definitions.
Sure. Cash is obvious. Cash equivalents are short-term, super liquid investments easily convertible to cash. Think money market funds, T-bills maturing in under 3 months.
Yeah.
Restricted cash is cash set aside for a specific purpose, may be required by a lender. If it's not available for general use, it might not be classified as a current asset.
Okay, we've covered the statements. Let's dig deeper into some key concepts. Revenue recognition, we mentioned the principle. But the source details a 5-step process. Why the extra detail?
Because revenue recognition can get complex. This 5-step model provides a solid framework. Step 1. Identify the contract with the customer. Is there a real agreement?
Okay. Step 2.
Identify the performance obligations. What exactly did we promise to deliver? Are they distinct items or bundled together?
Like, is the software license separate from the installation service?
Exactly. Step 3. Determine the transaction price. How much do we expect to get paid? This might involve estimating variable amounts like bonuses or considering financing components if payment is delayed.
Or if they pay with something other than cash.
Right, non-cash consideration needs value. Step 4. Allocate the transaction price. If there are multiple obligations, split the total price among them, usually based on their standalone selling prices.
What you'd charge for each part separately.
Correct. And finally, step 5. Recognize revenue when or as each obligation is satisfied. This is when control transfers to the customer. Could be over time, like a subscription, or at a point in time, like delivering a product.
That's quite a framework. Okay, next concept. Discontinued operations. What is that and why separate it out?
Discontinued operations is when a company sells off or plans to sell a major part of its business, like a whole division that represents a strategic shift.
Like a car company selling its motorcycle division.
Perfect example. It has to be a distinct component, operationally and financially separate. It's reported separately on the income statement, below income, from continuing operations.
Why below?
To make it clear that this income or loss isn't part of the ongoing core business, it helps investors focus on the results that are likely to continue.
So what gets reported for this discontinued part?
Two things, generally. The operating income or loss of that component up until it was sold or classified as held for sale, and the gain or loss on the actual disposal itself. If it's just held for sale, you might recognize an impairment loss if its value dropped, and the tax effect is shown separately too.
And on the balance sheet.
Assets and liabilities held for sale are shown separately, valued at the lower of their book value or fair value minus selling costs.
Okay. Let's talk earnings per share EPS. We hear this all the time. What does it actually tell us?
EPS is basically profit per share of common stock. It's a key metric for shareholders. Basic EPS is pretty straightforward. Net income available to common shareholders divided by the weighted average number of common shares outstanding.
Available to common shareholders means after preferred dividends.
Correct. You subtract any preferred dividends first. And weighted average just accounts for shares being issued or bought back during the year.
What about diluted EPS?
Diluted EPS comes in when a company has things like stock options or convertible bonds, securities that can become common stock.
Diluting the existing shareholder stake.
Potentially, yes. Diluted EPS shows the worst-case scenario, what EPS would be if all those potential shares were actually issued. It adjusts both the numerator, income, and the denominator shares for that potential dilution. It's always less than or equal to basic EPS.
Got it. Moving to receivables, the money customers owe. How do companies account for the fact that some people won't pay?
Right, that's the risk with selling on credit. Accounts receivable are shown on the balance sheet at net realizable value, the amount expected to be collected.
How do they estimate that?
Primarily through the allowance method for bad debts, which GAAP requires if bad debts are material. You estimate uncollectible amounts and record bad debt expense in the same period as the sale.
Matching principle again.
Exactly. You create an allowance for doubtful accounts, which is a contra asset, and it reduces the gross receivables balance.
How do they estimate the allowance amount?
Two main ways. The income statement approach uses a percentage of credit sales. The balance sheet approach looks at how old the receivables are. The older they are, the less likely they are to be collected, called aging of accounts.
And when a specific customer definitely won't pay.
You write off their account. You reduce both accounts receivable and the allowance for doubtful accounts. Note that this write-off itself doesn't affect net income or total assets because you already estimated the expense earlier.
What about cash discounts for paying early?
Companies use either the gross method, record full sale, recognize discount if taken, or the net method, record discounted sale, recognize extra revenue if discount not taken.
Okay, let's switch to inventory. What kinds are there and how is it tracked?
Inventory is goods held for sale. Manufacturers have raw materials, work in process, and finished goods. Retailers mostly have merchandise inventory.
And tracking it.
Two systems. Perpetual keeps a running count, updates inventory and cost of goods sold with every transaction. Periodic only updates at the end of the period after a physical count. You calculate cost of goods sold, then using a formula, beginning inventory plus purchases ending inventory.
What gets included in that ending inventory count?
Goods the company legally owns. Stuff on hand, goods in transit depending on FOB terms, shipping point versus destination, goods out on consignment.
And what costs are included in inventory value?
Purchase price, freight in, insurance in transit, any cost to get it ready and to the right location. Shipping costs out to customers are usually selling expenses, not inventory costs.
We hear about FIFO and LIFO. Why different methods?
Because tracking the exact cost of each item sold is usually impossible or impractical. So we use cost flow assumptions. FIFO is first in, first out, assumes the oldest goods are sold first. Ending inventory reflects the newest costs.
And
LIFO is last in, first out, assumes the newest goods are sold first. Ending inventory reflects older costs. LIFO can lower taxable income when prices rise, but it's not allowed under IFRS, and the IRS has conformity rules in the U.S.
There's also average cost.
Yep, average cost uses a weighted average of all costs to value both cost of goods sold and ending inventory. Companies choose a method and stick with it for comparability.
Inventory is valued at lower of cost and market LCM, or net realizable value, NRV. Why the markdown?
Conservatism. If the inventory's value drops below what you paid for it, you have to recognize that loss now. NRV is the estimated selling price less costs to complete and sell. Market for LCM is usually replacement cost, with ceiling NRV and floor limits. You write the inventory down to the lower value.
Okay, let's talk big tangible assets. Property, plant and equipment, or PP&E. What costs get included initially?
PP&E are long-lived assets used in operations, land, buildings, machinery. You capitalize the cost needed to acquire the asset and get it ready for use. Purchase price, taxes, shipping, installation.
What about land improvements or natural resources?
Land itself isn't depreciated, but land improvements like fences or parking lots are. Natural resources like mines include exploration and development costs, plus estimated future restoration costs, called asset retirement obligations, AROs.
What if you buy a bunch of assets together for one price?
A lump sum purchase. You allocate the total cost based on the relative fair market values of the individual assets.
And building your own asset.
Self-constructed assets include direct materials, direct labor, and a share of manufacturing overhead. You can also capitalize interest costs incurred during construction.
How are disposals or exchanges handled?
When you sell, you calculate gain or loss. Proceeds versus book value, cost less accumulated depreciation. For non-monetary exchanges, it depends if the exchange has commercial substance, meaning it changes future cash flows. If it does, you generally recognize gains and losses based on fair values. If not, you might defer a gain recognition.
Let's shift to R&D. How are those costs treated?
Generally, research and development, R&D costs, are expensed immediately as incurred.
Why expense them? Aren't they creating future value?
High uncertainty about future benefits, and it's hard to match the costs to specific future revenues. So GAAP says expense R&D costs like salaries, materials, depreciation on R&D equipment.
Any exceptions?
Yes, a big one is computer software development. Costs are expensed until technological feasibility is proven. After that, costs to get the software ready for sale are capitalized and amortized. Also, R&D acquired in a business combination is initially capitalized.
What about intangible assets, things without physical substance?
Right. Intangible assets like patents, copyrights, trademarks, franchises, they're recorded at cost initially.
Do they get expensed over time like PP&E?
If they have a finite life, like a patent, yes, that's called amortization, usually straight line. If they have an indefinite life, like goodwill or some trademarks, they aren't amortized. But
They get tested for impairment.
exactly. Tested at least annually to see if their value has dropped below their carrying amount.
Let's touch on the time value of money. Why is this concept important in accounting?
Because a dollar today isn't worth the same as a dollar next year. Time value of money recognizes interest earning potential and inflation. We use present value, what future cash is worth today, and future value, what current cash will be worth later, calculations.
Where are these used? All over.
Value in long-term notes, bonds, leases, calculating pension obligations. The source lists formulas for single sums, ordinary annuities, annuities due, perpetuities. It's fundamental for measuring long-term items accurately.
Okay, cost allocation. We mentioned depreciation, depletion, amortization. What's the core idea again?
Matching principle. Spreading the cost of long-lived assets over the periods they benefit. Depreciation for PP&E, except land. Depletion for natural resources. Amortization for finite life intangibles.
It's allocation, not valuation, right? Book value isn't market value.
Correct. It's just systematically expensing the asset's cost.
Mm-hmm.
Key factors are estimating the useful life, time, or activity, the allocation base, cost minus residual value, and choosing an allocation method.
Like straight line or accelerated methods.
Right. Straight line is simple, same amount each year. Accelerated methods like declining balance front-load the expense. Units of production bases it on actual usage.
What if an asset's value plummets? You mentioned impairment testing.
Yes, impairment occurs when the asset's carrying value, book value, isn't expected to be recovered through future cash flows. For PP&E and finite life intangibles, you test if indicators exist.
How does the test work?
Usually 2 steps. Step 1. Compare undiscounted future cash flows to book value. If cash flows are lower, it's potentially impaired. Step 2. The impairment loss is the difference between book value and fair value. Fair value is often based on discounted cash flows.
And indefinite life intangibles and goodwill.
Tested at least annually, comparing fair value to book value. Goodwill impairment is a bit more complex, involving comparing the fair value of the whole reporting unit.
What about costs incurred after buying an asset? Repairs, improvements?
Rule of thumb. Capitalize if it increases future benefits, extends life, increases capacity. Expense if it just maintains current benefits. Routine repairs, maintenance. Materiality matters. 2 small improvements might get expensed anyway.
We've covered so much detail. How do companies make sure users understand all this complexity?
Through financial statement disclosures. These are crucial. You have brief parenthetical disclosures right on the statements. Then detailed notes to the financial statements explain accounting policies, provide breakdowns of numbers, discuss contingencies, subsequent events.
And sometimes extra schedules.
Yes, supplemental schedules for even more detail. Full disclosure is key.
Finally, the auditor's report. What's their role?
The independent auditor provides an opinion on whether the financial statements are presented fairly according to GAAP and often on the effectiveness of internal controls.
So they check the company's work.
In essence, yes. They examine evidence, perform tests, and then issue a report. An unqualified opinion is a clean bill of health. A qualified opinion means mostly fair, except for something specific.
And bad opinions.
An adverse opinion means the statements are not fairly presented. A disclaimer of opinion means the auditor couldn't gather enough evidence to form an opinion at all.
Wow, okay. That was definitely a deep dive. We've covered the fundamental principles, the structure and purpose of those key financial statements, dug into concepts like revenue recognition, inventory, PP&E, and the auditor's role.
It really provides a solid framework for understanding how businesses track and report their financial story.
Absolutely. It's the language they use to talk about performance and position.
Hopefully, this gives you, the listener, a valuable shortcut to decoding that language.
So here's a thought to leave you with. Next time you look at a company's annual report, maybe glance at the auditor's opinion. Or think about their inventory method. Are they using FIFO or LIFO? And what might that signal about their results, especially if prices are changing? How do these choices reflect their strategy or financial health?
It connects these concepts back to real-world evaluation.
We really hope this dive has brought some clarity and maybe even sparked some more curiosity about the financial side of business. Thanks for joining us.